All right, with interest rates going up quite a lot in the recent weeks and months, I wanted to spend a minute on talking about preferred stocks. And this video is going to be geared for, say, an intermediate level investor who's familiar with what a preferred stock is, knows, that they're issued usually at $25 a share, that they're perpetual but can be called away by the issuer, and that they have a pretty low place in the hierarchy of creditors if there's a liquidation or a bankruptcy situation. So obviously the nice thing about preferreds is they pay usually a very attractive coupon, so they're bond-like in that sense. They also are like equity in the sense that if there's some existential threat to the company, they often trade down like the stock does because they're so low in the hierarchy of creditors. But then also there's some negatives about them. So the company can call the preferred stock away and then refinance it at lower prices if they want to. Kind of like if you think about a mortgage, but in reverse. Like you're now on the other side of the trade of the person who gets to refinance this paper. And so you're going to have, even though you think you have this pretty attractive looking coupon, and I think about like after the great financial crisis, there were a lot of banks that issued, say, 6% preferreds, and in a low interest rate environment, that's pretty attractive, right? But then if rates stay really low for a long time, a lot of the banks that had issued preferreds were able to refinance those preferreds. They basically could call away the existing preferreds that say yielded 6 or 6 and change percent and then reissue them. And I had this happen to me too. I had a couple of different bank preferreds that got called away. And then you're sort of stuck. Like you thought you had 6% paper, but now you don't. Now you have cash, right? And of course, it's extra painful if you paid well above par, because usually these bonds are just callable at par at $25 a share. So these are kind of trade-offs when interest rates are going lower and staying lower. Now we have kind of the opposite problem where interest rates have gone up a lot, and this preferred stock that you have that, again, yields, let's say, a hypothetical 6 or 6.5%, all of a sudden it doesn't look quite as attractive as it used to. And of course, we don't know what interest rates are going to do. They could keep on going higher. So 2 years ago, you could look at a 1-year CD and it would yield 90 basis points or less than 1%. Whereas you might have a preferred stock that yielded 5 or 5.5% or 6 even. And so obviously that delta is very significant. But the problem is 2 years later, CDs for 1-year CDs would yield 4% now. And probably a year from now, they're going to yield even more. I don't know what interest rates are going to do, but interest rates don't just go up and stop on a dime, right? So all of a sudden, the 6% paper that you had before, and remember, preferreds are perpetual paper as long as it's in the interest of the company to not call it away, right? So if rates skyrocket, I'd love to be a bank that has issued what looked like juicy 6% paper, but in the future, if rates go through 6%, then this is very attractive capital for this bank. And the nice thing about the bank is it's permanent capital at the bank's discretion, right? They can refinance at a lower rate by calling it and reissuing a new preferred. But if rates go up and go through the coupon on this preferred stock, they're just going to hang on to it because it's cheap. It becomes cheap capital because of the interest rate environment. So these are sort of the traps a little bit where you thought you had a preferred that you trusted because the underlying company was sound, and of course this is one element of choosing a preferred. But then you thought you had an attractive coupon, but you were wrong because interest rates moved through or moved up very significantly relative to that coupon. So I think this is one of the things where when there's an interest cycle where we have a down cycle of rates where rates stay lower for longer than people expected, you see the one negative of preferreds, which is they get called away and then you have to buy some other preferred at a lower yield, for example, or you get your cash back, right? And then you have a reinvestment problem at lower rates. And then now we have the opposite problem where rates have gone up and possibly will keep going up. And so this preferred stock that looked like it had a nice coupon is looking less and less attractive by the day, right? And so this is where, preferreds don't really lend themselves. You can't ladder, with like a time ladder, you can't ladder out preferreds. You're at the whim kind of the issuer, whether he calls it away or not. And in a way, like right now, it might be a better idea to ladder out some CDs of different time periods, and then you get to refinance those CDs when they mature a year or 2 years from now, and you'll have access to market rates at that time. Of course, that also is a bet on interest rates, right? We don't know what rates are going to do. But the point about the preferreds is you don't really have this kind of choice. It's the issuer's choice. The company that sold this preferred to you, it's their choice whether to refinance. Obviously, they're going to refinance when it's good for them, not good for you. Okay? So just some thoughts on preferreds. They are a component of an investment portfolio. I own some. They have benefits and drawbacks. Just like everything else in investing, there's trade-offs. Right now, we're seeing one of the trade-offs, negative trade-offs, that come when overall interest rates have risen a lot and you're holding preferreds that look less attractive than they did before. Okay? That's it for today. Thanks for watching.